Welcome, everyone, and thanks for joining us today for what every financial planner needs to know about self-directed IRAs. The webinar will last approximately 15 minutes, and at the end, you will be given an opportunity to receive supporting materials by email free of charge to you. You will also be told how you may email questions related to today's content to the presenter. Today's presenter is Linus Sugis. Linus worked for a Chicago-based insurance company in various roles, including Director of Advanced Sales and as Chief Marketing Officer. He ran and sold a successful estate planning law practice in Franklin, Tennessee. Linus also writes the publication Think About It, founded by life insurance industry guru Steve Limberg, and Linus regularly speaks at industry events. His new book, Sell Out, The Busy Entrepreneur's Guide to Transferring a Closely Held Business, written together with a CPA and a business broker, is now available on Amazon.com. Linus will draw on his legal, tax, and life insurance background and practical experience for today's webinar. And here he is.
Thanks, Jennifer, and good morning or good afternoon, everyone. We're going to talk today about self-directed IRAs. We get lots of questions here at Advanced Underwriting Consultants about self-directed IRAs. The questions tend to be client-driven. The client, has heard that they can invest their IRA in unusual assets, and the question comes up with the life insurance professional, the financial professional, what is a self-directed IRA? Can you do one? The point of today, the next 15 minutes or so that we're going to spend together, is just to give you some background into how self-directed IRAs work, what are some of the pitfalls, what are some of the downsides of self-directed IRAs as opposed to, more shelf IRAs, more standard IRAs, and how you can best be equipped to answer your clients' questions about them. And so we'll talk about that in just a little bit of detail starting in a few minutes. But before we get there, let's talk about what it is that we'll talk about next month. Help us to pick a topic. We're going to have a poll here, which gives you the opportunity to tell us what you want to hear about in next month's webinar, whether you want to hear about 60-day rollovers, whether you want to hear about the IRS's targeted list of dirty dozen things that taxpayers ought to look out for, or whether you want to hear about the answers that we don't know the questions that we don't know the answer to, the technical and tax questions that we don't know the answer to. We're going to give you an opportunity to vote in the poll, and Jennifer, if you would go ahead and manage or start that poll right now. Let's go. Go ahead and vote. Have about 15 seconds, if you would. Go ahead and finish up voting if you haven't yet voted. All right, looks like all the votes are in, and we'll go ahead and close the poll, and we'll let you know that the IRS is going to do, it's the IRS Dirty Dozen list for next month. Thank you for participating in that. Thank you for letting us know what you want to hear about, and that's what we'll talk about next month. So forget about next month for a minute. Let's talk about this month. Let's talk about individual retirement accounts. And obviously, IRAs are an important component of our clients' retirement planning. Most of our clients are comfortable in dealing with us, dealing with insurance companies, dealing with other money managers to make investment decisions with regard to their individual retirement accounts. But a fair number of our clients are also more interested in more control Some want total control, a do-it-yourself approach to investing their IRA money. And they may find out that a self-directed IRA is in the mix of the things that they want to know about. In theory, a self-directed IRA will allow them to make complete investment decisions about what it is that their what their IRA money sits in. The ability to invest in anything is restricted. There are some things that IRAs cannot invest in. We'll talk about that in a second. But in theory, IRAs can invest in almost anything. But a true self-directed IRA is something that our insurance companies and most of our financial institutions aren't interested in taking on because they don't know anything about those assets. They don't have the ability to trade those assets. And so they're not in a position to help facilitate their clients investing in just about anything they want to. So for most of our standard carriers, life insurance companies, banks, brokerage operations, they are not the candidates to administer self-directed IRAs. You're going to have to find a different custodian for that. Now, self-directed IRA can be either a traditional IRA or a Roth IRA. What we've seen in the real world is that for people who really are optimistic about their own investment buckets, their own investment choices, that Roth IRA, a self-directed Roth IRA, may be the way to go, because if you believe in your investment, you believe it's going to appreciate dramatically. If it's invested in a Roth IRA, all of that investment return is going to be income tax free for the Roth IRA owner as long as they meet the two-part test. And again, the two-part test is that their Roth experience, the taxpayer's Roth experience, is more than 5 years old. And the second part of the test is the taxpayer is older than 59 and a half. And so if the taxpayer has a self-directed Roth IRA and meets those tests, all the returns from their investment when they're taken out are going to be income tax free. So anyway, that's the analysis there. But self-directed IRA can be either Roth or a traditional IRA. Here's a quick math example with Marvin in a 32% tax bracket, putting $5,000 into an IRA. If he makes that contribution to a Roth, he's going to owe $1,200 federal income tax in making his after-tax contribution. And then the $5,000, if it grows, it's 7% a year. And most of our self-directed IRA investors are optimistic that they're going to get that kind of return. That'll be $40,000 at age 70, 30 years later. And it's going to be all tax-free on the back end. And so that'll feel really good for Marvin. If he put that money in a traditional IRA instead and all the same stuff happened, he's going to have to pay taxes on a $40,000 distribution later on of $9,600. So the question is, which would he prefer to do? Does he want to have to deal with the income tax result on the contribution now, or on the taxes on the distribution later on? The taxes later on are going to be a much bigger amount. So we're not saying one way or another. It has to do in part with what Marvin expects income tax rates to be later on. Whether he believes that the current taxation of traditional IRAs and Roth IRAs will continue to be persistent and stay the same. All of that stuff matters in determining whether or not he's going to decide to put the money into traditional IRA or a self-directed Roth IRA account. Also, with regard to IRAs and self-directed IRAs, a lot of times the taxpayer is going to be interested in making illiquid investments. And so if the investment is illiquid in a self-directed IRA, the ability to take RMDs when the taxpayer gets to 70.5, that may be challenged if the traditional IRA, the self-directed traditional IRA, is still invested in an illiquid asset. If there isn't enough cash in the IRA to make the RMD work, the RMD's got to be taken, and somehow the taxpayer is going to have to come up with the cash, or the taxpayer is going to risk the 50% failure to take RMD penalty tax. And so that needs to be thought about. It's one of the other advantages of a Roth IRA. Roth IRA during the taxpayer's lifetime has no RMD requirement, and so the illiquidity, at least while the taxpayer is alive, the illiquidity doesn't really matter. So let's talk something about prohibited investments. So one of the things that the taxpayer is going to have to do is going to have to find an IRA custodian that will allow him or her to invest in assets of their choosing. There are certain kinds of assets that Congress and the IRS will not permit into an IRA. It is clear that IRAs cannot generally invest in life insurance or collectibles. Now, there are certain kinds of collectibles that are an exception to the general rule. For example, U.S. gold, silver, and platinum coins, metal bullion, those kinds of collectibles typically are allowed. But those kinds of investments don't create an income. They're kind of speculative in nature. They're not ideal for some IRA owners, particularly those with traditional IRAs who are expecting to have to take RMDs. They'll have to liquidate some of their positions to be able to do their RMDs, and liquidation may come in at an inopportune time. So if IRA funds are invested in anything that is prohibited, and we'll talk about other prohibitions in addition to the life insurance and collectibles in a minute, the IRA will become disqualified, and whatever the value of the investment is at a minimum, and perhaps the whole IRA will be considered to be undone. The entire value will be distributed, and if it's a traditional IRA, all of the value, including any earnings, will be subject to a 10% early distribution penalty if it's done before 59.5. IRAs also cannot invest in S corporations because only individuals can be S corporation owners. What else can an IRA not invest in? Well, we get this kind of question from callers all the time. My client wants to buy a vacation rental house with his IRA money. Well, the question is, well, will the IRA owner ever live in the investment house? And usually the answer is yes. That's the intention, that the IRA owner will live in the house, the rental house, for part of the year. The house will be rented out for the rest of the year, and the hope is that the IRA owner will be able to use IRA money to buy the rental house. That's an act of self-dealing. You can't enter into, or you can't have your IRA enter into an act of self-dealing with a disqualified person. So if the IRA buys something that benefits the account holder, a family member of the account holder, a business in which the account holder has any kind of ownership or controlling interest, the account owner's employer, and some other folks that are related to the account holder, that's a prohibited transaction. If the IRA engages in a prohibited transaction, it's going to disqualify the IRA. And you can begin to see that with a self-directed IRA, where the taxpayer has the ability to decide what to invest in, it's really easy for the taxpayer to invest in something which is prohibited. And if that happens, it screws everything up. What else is a prohibited transaction? The IRS may not borrow money. So in the vacation home example, if the plan is to finance part of the purchase price for the vacation home, even if the taxpayer or the taxpayer's family doesn't plan to ever use the vacation home, that it's purely for investment purposes, if the IRA has to borrow money to complete the purchase transaction, it's not going to work. The IRS is not allowed to borrow money. If the taxpayer owns something, the taxpayer's own self, and tries to sell it to the IRA, that's not going to work. If the taxpayer tries to lease a commercial property that the IRA owns for the taxpayer's own personal use, that's a prohibited transaction. If the taxpayer tries to collect compensation for managing something that is owned by the IRA, there's a good chance that that's going to be a prohibited transaction. Using IRA money as security for a loan, that's all prohibited transaction stuff. We mentioned earlier that IRA purchases an office building, he can't lease space from the building for his own business. IRA purchases real estate can't be leased to a family member even if rent is paid. Those are acts of self-dealing. They are prohibited transactions. Somebody tries to sell their primary residence because they're low on cash. Even if they're not going to live in their primary residence, they can't do that because it's an act of self-dealing. Because in essence, the taxpayer is on both ends of the transaction, and it disqualifies the IRA. So what happens when the IRA engages in a prohibited transaction? The IRA stops being an IRA. The IRA is considered as distributed, and the fair market value is subject to income tax and the penalty tax. And it doesn't really matter what kind of prohibited transaction takes place. It's the same result. The minute the prohibited transaction takes place, the IRS determines that it did. The IRA ends. The account is considered to be distributed, and the taxpayer owes taxes if the money had actually been distributed. Same is true on a Roth IRA. Although, on a Roth IRA, the policy owner or the account owner gets credit for basis, and that is returned income tax free. But to the extent the account is considered liquidated, if there's value in excess of basis, the gain is subject to both income tax and the penalty tax. So how does a client set up a self-directed IRA? Assuming that they're still in line for this. They got to find it. The main thing is they got to find a custodian. There are custodians that deal with self-directed IRAs. They are all over the place on how much service they provide to the taxpayer, what kinds of investments they will allow, and what kinds of fees they charge. Because the market is kind of limited, there aren't an overwhelming number of self-directed IRA custodians available that have good reputations. Their fee structure tends to be higher than the fee structure that would be imposed in a more traditional IRA. So the market is more limited, and depending on the kinds of investments that the client wants to make, they'll have to shop pretty carefully for the right kind of self-directed IRA custodian. Whether the IRA or Roth IRA is self-directed or not, the taxpayer is still limited to the normal kinds of IRA contributions, the normal limits on IRA contributions, depending on how old they are. And so usually it makes sense for a taxpayer to think about a self-directed IRA if they've got a rollover contribution from some qualified plan to be able to jumpstart the contribution. And that has as much to do with putting a substantial investment in a non-standard place, as well as covering the higher expense structure associated with what the self-directed IRA custodian will charge. So most of the time, the client needs to have a substantial amount from a rollover source to make investing in a self-directed IRA sensible. There's a lot of control that the self-directed IRA gives a client. Some custodians essentially give the client checkbook control, give the client the freedom to go invest in anything. That's the good part of it. The bad part of it is, as we talked about earlier, it's very easy for somebody who's not aware of the prohibited transaction rules to screw it up and to invest in something that's wrong and put everything at risk. And so that's kind of the upside and the downside. So in some cases, IRA monies can be used to invest in a closely held business, but the rules are really particular about when that can happen. There's the example here on this slide of the PayPal owner being able to use his Roth IRA money to buy stock in PayPal, and the situation was one that he was able to use his self-directed IRA to invest in PayPal, and it worked out for him, but he didn't have enough control over the PayPal company to make it a prohibited transaction, at least arguably. What is it that our clients want to invest in self-directed IRAs? They want to invest in real estate. What they got to remember, though, is that the IRA owns the real estate. That rents, if they're paid, are paid to the IRA and not to them. They don't get things like depreciation deductions like they would for real estate that they own personally. They aren't able to take advantage of 1031 or capital gains treatment necessarily if the IRA is the owner. And anything that gets distributed from the IRA ultimately is subject to ordinary income tax rather than capital gains treatment. And so, those are some of the downsides of using a self-directed IRA as a conduit for real estate as opposed to something else. So, having said all that, self-directed IRAs, if they're done well, they still have the normal protections that IRAs have, protections against the claims of creditors in a lot of places, protections in bankruptcy that other kinds of plans don't have. But the downside of a self-directed IRA is the bottom line is it's not for the faint of heart. Putting retirement savings into one piece of real estate or one startup business, that's dangerous. If the account holder is making all of the account owner's own investment decisions, the risk may be greater than they anticipate. And of course, the costs of setting up a self-directed IRA and engaging in prohibited transactions, the risk of engaging in prohibited transactions, will probably drive most people away from that choice if you can explain it properly. So really, that's the overview of self-directed IRAs. You have to have a working knowledge about them in order to give good advice to your clients. I hope that the brief overview today has helped you with that. If you have other questions about self-directed IRAs, you want to know more about them, feel welcome to get in touch with us. Jennifer will tell you how to get materials, more detailed materials related to today's sessions. I'm glad you joined us today. And at this point, I'll turn it back over to Jennifer to wrap it up.
Thanks, Linus, and thanks for joining us today. As a reminder, if you would like to receive supporting materials, feel welcome to email me at asktheexpert@advancedunderwriting.com. Again, that's asktheexpert@advancedunderwriting.com. You may also email questions related to today's webinar. Finally, for more information about the services that advanced underwriting consultants offer, including phone consultations and newsletter licensing, feel welcome to contact me at 615-224-1291. Again, that's 615-224-1291. Thanks again, and best wishes for continued success.